proceed to our next session on the changes in transfer pricing and international taxation. We are pleased to welcome Aseem Chawla to guide us through this critical topic. Mr. Chawla is a senior advocate, fellow chartered accountant, and member of the Bar Council of India. With over 2 decades of experience, his specializes in estate planning, international tax, corporate advisory, and dispute resolution. He serves as a senior standing counsel for Income Tax Department in Delhi and holds leadership position in various legal and industry bodies. Widely recognized in the Asia Pacific region, Asim continues to be ranked among the top legal professional for his expertise. Welcome, sir.
Thank you, Divya, for that very kind introduction. In fact, we've all been students and will remain students all along. And in this journey of learning, I think Taxman has played an important and continues to play an integral role in making sure that all of us are up speed in terms of our knowledge curve and remain relevant. And grateful to yourselves, the entire editorial team, Naveen, Rahul, yourselves, and Cynthia for helping us in being able to share our views on your very illustrious platform. And your collective erudition speaks the love for law which all of you have. Uh,
Thank you so much, sir.
I think you have the slides for the viewers available, and I'll request yourselves and your IT team to navigate the slides if those are going to be disseminated to the audience now or later. I would
Okay.
leave that to your collective wisdom. Uh, I think very broadly, the game, the most talked about change insofar as, or the proposal, if I may use that word, has been with regard to introduction of a block period for the purposes of transfer pricing assessment and some streamlining or ironing out creases insofar as the definition of capital asset is concerned and aligning the definition of or the inclusions or in with regard to uh, the exclusions with regard to, my apologies, not inclusion but exclusions with regard to the scope and ambit of significant economic presence when compared with the Indian recognized concept of place of business, which is the business connection. And then, of course, to give a fillip to everything surrounding the electronic component manufacturing space, which is pretty much the talk of the town, so to speak, with raising capabilities in and around artificial intelligence, in development in the field of high tech. I think what India has done is given a position with regard to providing a certainty in terms of incorporating a provision of incorporating a provision in its domestic tax law with regard to providing a presumptive rate of taxation to the ecosystem. I think that's something which has been widely hailed all around, and I think it was a big ask, and the relevant nodal ministry also did recognize the uncertainties which the tax provisions sometimes do bring in when it comes to its implementation. The last piece which we are going to cover is the rationalization of taxation of capital gains on transfer of capital asset by non-residents in terms of aligning the rates so that there is no arbitrage in terms of rates. So if we could move to the next slide, please. Yeah, just the next slide, please. Yeah, so these are the broad 6 topics which we thought were relevant for today's discourse. And of course, in the coming weeks, if there is any particular area which we need to delve it in terms of a better deep dive, I think that we could do. But as part of the ongoing day-long marathon, I think suffice to suggest that if we could very quickly, in the given allotted time, can wrap up this. So let's look at the first big proposal, which is with regard to harmonization of SEP concept with reference to business connection. Yeah, yeah. Let's move to the next slide, please. So Section 9 introduced the concept of significant economic presence a few years ago, in line with the tenets or the commandment which we did get in terms of the base erosion and profit shifting proposal as a good advisory. And to preserve the source base, we did introduce the concept of significant economic presence, which widens the ambit of a source-based taxation or the ability to tax something on a source base. Suffice to suggest that the treaties so far have not been amended. So, therefore, if something does fall within the ambit of significant economic presence for the purposes of domestic tax law, or let's say a foreign entity's activities in India do constitute a significant economic presence, but that foreign entity is entitled to claim the benefits of the tax treaty. Considering that SEP has a concept has not been introduced in the treaty, that particular entity may take treaty refuge and, excuse me, that particular entity may take the treaty refuge and would continue to be taxed in accordance with the provisions of treaty, read with wherever there is an impact of MLI, so to speak. So put it in simplistic terms. Now, all along, our Income Tax Act has recognized the concept of business connection as a virtual projection of a foreign entity's affairs in India, whether it constitutes a business connection or not. No, no, don't change the slide. Just explaining the. Go back, please. Go back. I'll let you know when I need to flip the slides. So, if a foreign entity has some taxable presence in India, under the scheme of the Act, that taxable presence is given the coinage of business connection. Now, business connection over a period of time has been interpreted right from the days of R.D. Agarwala, the seminal judgment, and it is wider in scope as compared to permanent establishment. So, business connection is expansive in scope. Permanent establishment is a little, it's a concept which is not as wide as business connection. So, if you have a business connection, but you are entitled to tax benefits and you do not constitute a PE, then by virtue of treaty, you can safely ride home. Similarly, you have a significant economic presence under the scheme of the Act, but you do not have a permanent establishment, then still you can ride home well. The incongruity which was being felt was that, well, there is a concept of SCP which has been introduced. There is a concept of business connection, but in so far as the activities are concerned with regard to purposes of export, whether mere purchase of goods in India for the purpose of SCP, for the purpose of SCP would tick the box, whereas for the purpose of business connection, there is a specific exclusion which has been provided. I think that was just to align the fact that merely purchase of goods would not constitute an ACP because it does not constitute business connection. So that was just to bring parity to both the concept. Suffice to suggest that in situations where a treaty benefit is not available, or you're uh, indulging in a transaction from a country which is not which does not have treaty benefits, or for some reasons you are not entitled to treaty benefits, then the exposure of SCP would loom large. And therefore, in the present world of uh, tax treaty entitlements and principal purpose test, whether the intent and purpose of the benefits being claimed under the tax treaty, etc., are being uh, are likely to be challenged by revenue, or if they are challenged, then in a worst case scenario, the activities should be such that if they are in a nature which are vulnerable to a constitution of significant economic presence, that must be seen. And therefore, uh, if the foreign company is transacting from a treaty country, then make sure that the basic checklist in terms of claim of benefits of tax treaty and the entitlements are met good, so that the shield of tax treaty in terms of affording concessional tax treatment holds good. So that's the limited purpose. And this little longish background was for those of the viewers who wanted to just get updated with the latest prescription. Of course, suffice to suggest that the recent executive orders pronounced by the Trump administration would, if not derail, at least sidetrack the progress which the world was making in terms of Pillar One and Pillar Two. So the momentum may receive a hiatus for a little while. There may be a pause button, and in fact, India's Honorable Finance and Revenue Secretary also has gone on record that in view of the US decision to sort of revisit the global minimum tax, even India uh, would act in a circumspect manner. That is why in this budget, as well as in the last budget, we did not have any legislative changes with regard to enabling provisions on Pillar 1 and Pillar 2 global minimum tax and taxation, which inures some source base to market jurisdictions in terms of the Pillar 1. Uh, Whether the new income tax bill forthcoming will take those into consideration as an enabling measure, I would be a little tentative or less certain about it, because the globe itself, when I say the word globe, not global minimum tax, the world at large is facing some sort of an uncertainty with regard to the disposition of United States in buying in this. Remember, it's one of the largest technology exporting countries of the world, and they also need to preserve their tax base, especially in comes when it comes to the Pillar One, as well as the global minimum tax, which will be applicable to big companies exceeding revenues over 750 million euros or so. Yeah. Next slide, please. Yeah, this is the game changer or the highlight of the tax proposals dealing with international tax insofar as the tax proposals announced by the finance minister on 1st of Feb 2025. So Finance Act 25 will be remembered for this very enabling provision. If we go a slide back, we have a concept now where a taxpayer can exercise an option of electing that uh, insofar as transfer pricing is concerned, it may seek an option. And if we go a slide back, that the international transactions for that given block would be considered at one go, so that you don't have to reinvent the wheel. So if we go a slide back for a moment, please. Yeah. So at one go, you could have a situation where the determination of arm's length price shall be applicable for a period of 3 years. And given the guidelines which are expected within a period of less than 3 months before the audit process really gets kicked in, there would be a certain set of guidelines or certain prescription which would be unveiled by CBDT basis introduction of some rules or instructions. And if the taxpayer does comply or wishes and believes that the prerequisites of those guidance or instructions are met, and basis that decides to elect the option that at one go let the transfer pricing be determined for a given period of 3 years, then he shall submit having elected or chosen that option in a prescribed format, and the filing shall be done in accordance with those rules. As I said, the guidance and the amendments in rules are expected within a period of 3 months. The CBDT has gone on record to make that statement day before yesterday, if you would have seen the press. So once it is you elect the option, then the transfer pricing determination is done, and that's applicable for a given block of 3 years. And therefore, instead of reinventing the wheel every year for the same set of facts, the same comparables, etc., I think this economizes both the effort of the revenue as well as of the taxpayer. Suffice to say that in that period of block year, you are looking at international transactions which remain consistent. Your MAMs, the most appropriate methods, your comparability analysis, your selection of filters largely hover around the same baseline of a common, consistent international transaction, and you don't expect too much of corporate restructuring or change in the manner in which you are doing international trade in terms of your transactions with associated enterprise. So if the baseline remains the same, and especially helps those industries where they are on a set sort of a template of doing business, which does not get revisited every year. If the business is passing through a very dynamic phase and you're not sure about the next year in terms of your outlook of your international transactions, then I don't think this would help awaiting the fine print in terms of the amendment in rules and instructions. I think this is more for those businesses which are pretty much in that autopilot mode and are gliding along nicely. Yeah, we can move to the next slide. So this is not applicable for those where search has taken place. The enabling provision in terms of subsection 21 to section 155 has already been introduced. Reference will not be made again for transaction for which option is exercised. So the department is stopped. They will not make a reference under 92 CA. And the TPO, the transfer pricing officer, by an order within 1 month from the end of the month in which the option is exercised, declare whether the option is valid, again subject to certain uh, preconditions, etc., which I think would be apprised either in time, or the guidance and the instruction would be such that it's pretty much fathomable to understand that what would be those likely preconditions, so that a taxpayer is not caught by surprise in terms of what comes forward, and he finds himself in a in a cornered situation where, though he wanted to exercise the option, but the preconditions are such that he's been caught by a surprise, and therefore the CFO and the tax head and the management of the larger company, including its international affiliates and associated enterprise, do stumble upon some sort of unpleasant surprise. Yeah, next slide, please. Yeah. Now, this is again a very sort of helpful or a welcome amendment insofar as making the amendment the amendments made in capital definition of capital asset have now been uh, extended insofar as the alternate investment funds are concerned. If you remember a few years ago, in case of FIII, the whole uncertainty with regard to taxation of FII, and we had the whole stock market getting wobbly, and then to set it right, the amendment was made within the Income Tax Act that for the purposes of foreign institutional investors, it would form part of the capital asset, so to speak. And capital asset is a defined term under Section 214 of the Act. And to now provide the same enabling characterization for investment funds which are AIF Category 1 or Category 2, or the funds which are governed under the Gift City International Financial Center, so to speak. Uh, the same prescription would follow. So the uncertainty with regard to characterization of income for the purpose of 115 UB, which is applicable to AIFs Cat 1, Cat 2, and IFCA is concerned, they would be regarded as capital asset, and therefore any income arising would partake the character of capital gain. So as a result thereof, what happens? Uh, by virtue of this, the transfer of securities shall be taxed as capital gains, and therefore the income shall be treated as a pass-through and will be taxed in the hands of the unit holder and not in the hands of investment funds. This was a long pending ask uh, which on which the positions were being taken by tax experts, but now there is a legislative certainty prescribed in the act itself. So I think that's a very welcome legislative change which has been proposed, considering the ask of the industry. And BFSI is pretty much driving the economy. The more investments are being made in formalized sector with the SEBI-regulated AIFs, I think the more monies are going to get channelized into formalization of economy. Yeah, next slide, please. Next slide, please. Again, this particular amendment in terms of IFC related amendment is concerned. So, with a view to facilitate the operations in the IFSC, International Financial Services Center, there is an amendment which is proposed in clause 4 capital E of section 10, which provides now that income of non-resident on account of transfer of non-derivative deliverable forward contracts or offshore derivative instruments or OTC entered into by IFC shall not be included in total income. So this is again to provide certainty to the prescription of transactions which the non-resident was undertaking with the IFC is concerned. So I think again this makes the whole proposition of doing business in the offshore financial center in Gift City far more attractive and provides such uncertainty. But remember, this exemption is available to non-resident and not to the FPI. So this is an important aspect which one needs to uh, consider in mind, that these benefits are not extended to transactions entered into with a foreign portfolio investor. These exemptions are available to the end investor who is the non-resident. Remember, these schemes are available for non-residents as such, and it is the non-residents who are eligible to participate in such schemes and in such dispensation, and not a resident. Suffice to suggest that IFC, for all legal purposes, is an offshore territory, although geographically located in Gandhinagar in Gujarat, but for legal and tax purposes and for exchange control purposes, it is regarded as a territory outside India. So therefore, these schemes and these dispensations which are available, they are available to non-residents who are non-resident for exchange control FEMA purposes and non-residents for tax purposes. So therefore, when you think of IFC or Gift City, keep in mind that this is catering to the offshore business, and therefore offshore business means business being done offshore, and therefore per se, on first principles, these are not enabling Indian businesses, so to say, insofar as this particular line of business is concerned. Of course, Indian businesses can set up their nominated entities within the gift city to carry on offshore businesses. That's a different aspect of discussion altogether. But when we are looking at things like entering into forward contracts or offshore derivative instruments or OTCs, etc., uh, which are with an offshore banking unit of an IFC. So IFC may have a Deutsche Bank or a State Bank of India, and I am a non-resident residing outside India. Instead of transacting with Deutsche Bank Germany, I'm transacting with Deutsche Bank in Gandhinagar. And therefore, just because it is in Gandhinagar doesn't mean that it will be subject to tax. The taxation treatment will depend upon the prescription provided. And here, in terms of clause 4E, such particular kind of exemption is being made available to the non-resident and not to the foreign portfolio investor. Yeah, next slide, please. Yeah, this is again one of the big highlights of the budget. I think the industry mighty Ministry for Information Technology could realize that foreign companies are a little tentative in terms of setting up greenfield projects in India with regard to electronic manufacturing, enabling space, be it chips or supercomputer. Today only, you saw in the newspaper big proposals being announced with regard to investments in AI in India. You had the OpenAI, the CEO in India, meeting the Honorable Minister Vaishnav, who's leading from the front insofar as India's development and pacing forward in AI as part of the initiative under information technology. So the certainty has been provided is that okay, we can give you a presumptive regime, which we all understand is available for historically oil and gas and other notified industries, that if you have issues with regard to permanent establishment, constitution of service fee, technical personnel coming out going out of India, coming into India, constitution of P, and the biggest challenge is the attribution that okay, I may have a P in India, but how much you are going to attribute income has always been a vexed issue with the revenue. So to sort of give a comfort, a new provision in terms of Section 44 double BD has been introduced, which deems 25% of the amount received or which is payable to a non-resident as business profits of such non-resident. So it is deeming provision with regard to 25% of the aggregate amount. It doesn't say 25% of the tax. Now you apply the tax rate on 25%. The government on record has gone to state that it will be a very attractive regime in terms of the net tax payout. Uh, yeah. So this would facilitate all the big IT and AI players who are keen and have expressed interest in terms of making huge capital investment in such fields. Yeah, next slide, please. Now, coming to towards the almost the fag end of the broad highlights which the budget dealt with insofar as dealing with headline uh, amendments on international taxation is with regard to the amendments in provisions of Section 115 AD, which now has been amended uh, to provide that long-term capital gains for all securities except those are referred to in 115 AB shall be taxed at the rate of 12.5%. The benefit of 1.25 lakhs, the basic slab, and we move to the next slide, please. Oh, the benefit, go back. Uh, the benefit of 1.25 lakhs is only provided for capital gains from transfer of long-term capital asset referred to in 112A, where payment of STT is involved. And the rate of tax of for income for the period 23rd of July 2024 to 31st of March 2025 of the given long-term capital asset not falling under 112A, where STT is paid, shall remain at 10%. So this is just to give parity in terms of the taxation rate between resident and non-resident. So this was the basic intent of making amendments in terms of Section 115 capital AD of the Act is concerned. It's, I'm more than happy to take questions or any point which the viewer uh, or the delegate wishes to deliberate a little more in terms of developments in international taxation, especially what is in store in the coming week in terms of new bill, but suffice to suggest the broad highlights of this particular budget is the introduction of the block period for transfer pricing, the provisions of presumptive taxation dealing with electronic manufacturing facility, further incentivizing the IFC framework, the gift city framework for the ecosystem in terms of financial and tax concession. And remember, the rest of the world wants certainty in tax laws, and therefore they want provisions to be built in the tax law rather than uh, getting it relegated to the subjective determination of the assessing officer, which may vary from a particular officer to a particular officer, even in the faceless regime. So, all the amendments which you now find with regard to tax incentives being made available to non-residents or foreign investors, you will find some in most of the cases the amendments are being sought to be made or are seen to be made in the Income Tax Act in so far as if I can give you some reference also, the sovereign wealth funds which came from Middle East also made it a point perhaps to see that the amendments with regard to tax benefits are spelled out in the tax act itself by naming those funds so that there is no tomorrow there is no a doubt or it is subjected to whims and fancies of a given particular officer or a given particular situation. So that's the kind of certainty which the world expects in the taxation framework. And to that extent, I think the yearly amendments which we see in the regulations, the tax regulations pertaining to operations of gift city is again to confirm to the rest of the world that, well, the enabling provision is in the act itself. You don't have to take recourse of treaties also. And if it is exempt under the act, the question of going to the treaty does not arise at all. And that's a settled jurisprudence. Uh, Similarly, the discussions which we had in terms of the amendments made with regard to change in the definition of capital asset, which impacts positively the taxation regime available for alternate investment fund Cat 1, Cat 2, and the IFSC denominated fund is a very welcome change. Now the particular taxation will be in the hands of not in the hands of the will be passed through and therefore will be taxed in the hands of the investor. And remember, each investor's taxation would be different from others. And if it is taxed not at the if it is taxed at the fund level, then the ability of the investor to plan his or her affairs may get a little more rigid, and he or she may not enjoy that flexibility because every investor's taxation varies from the other person. And once it is going to be taxed at the investor level, then he or she knows that what is the tax treatment or the tax outflow of this particular investment, and he or she can plan his or her overall tax outflow for that particular fiscal year. If it is going to be taxed at a fund level, then regardless of my individual situation, I will have to follow that taxation and either claim more refund or pay more taxes. So it may not give me a very bespoke solution, so to speak. So I think to that extent it is a very welcome move. The first amendment, proposed amendment with regard to tinkering with the exclusions under SCP is more or less to bring it aligned with business connection. But then you have the larger safeguard of tax treaty available before the exposure of significant economic presence does keep in place. I think the rules with regard to facilitating the block transfer pricing audit for that given period will make a lot of difference to figure out how tax friendly it is going to be. So these are all in all changes. If there are any questions, more than happy to take.
Thank you, sir. Thank you so much for this insightful session. There are a couple of queries.
Yeah.
There's one query in the in the chat box.
Can you read it out, please?
Yes, sir. I understand that TP block selection will be a cure any transaction. So, in a situation where the SSC has more than one international transaction and selects one or more and not at all the transactions, how will this block work practically?
Yeah, I think the viewer who has posed this should need to wait for a little more time just to see that what kind of prescription the CBDT were to come up with, whether they allow the entire reference of that particular year to be included in block, or the taxpayer will get more elbow room in terms of picking and choosing some and some not, because the underlying intention is to avoid a repetitive exercise, so to speak. So I think let's wait for the amendments in the rules, so to speak, and which they have said that they should bring it within less than period of 3 months. Yeah.
Okay. The next is, will the provisions using presumptive taxation for non-resident with respect to the tax received from sale of supplies also covered in the calculation for applying the presumptive tax?
Well, it's largely hovers around services with regard to sale per se. I think why would you, at the first instance, why would you expose an offshore sale to an Indian tax? All along, the non-residents have been espousing the cause that if the sale has been consummated outside India, then it should not be subject to India, subject to the anti-fragmentation rules which are applicable in some treaties pursuant to MLI. Largely, the call of the non-resident community with regard to sale is that it is being fructified outside India, unless yours is a case where it is it is getting consummated in India, and therefore there is a tax exposure around this. So I would rather suggest that you should go back to the drawing board and look at it. Otherwise, the helpful jurisprudence of the LGs of the world and the IHIs of the world would are the Lindays. I mean, all these are pronouncements which have withstood the test of time. Yeah.
Thank you, sir. There are few more queries. Should I take it?
Yeah, because we just have few more minutes. I want to fill up before you have your next panelist. Otherwise, there'll be an outage. So let's
Yes.
take one or
Yes.
two more.
Yes, sir. The another is, do you think the government should reduce compliances and simplify provisions for issues related to international taxation?
Yeah, of course, why it should, and therefore, at least international taxation helpfully is out of the faceless ambit, which gives more opportunity for taxpayers to have a interactive, in-person sort of interaction with the tax department, and even the tax department is very cognizant insofar as dealing with non-residents is concerned. The only concern area of concern or sort of some sort of advisory I have on the table is the fact that the general thought process is that the information sought for does not come very quickly from the non-resident taxpayers, or there is a hesitancy to share information. So remember, when unless it is not deliberate, I don't think it serves any purpose, because if the general impression in the course of your interaction is such that, well, you are hesitant to share information, then of course you will be viewed not with certain amount of circumspect, which is very natural or human, so to speak. So my suggestion is that please share as much as you can upfront, because more often than not, when the matters are litigated and they travel to the superior appellate forums, at that point in time, everything comes up. Even my own experience of dealing with matters is that more often than not, at the tax tribunal stage, we are filing additional evidences which suggest the fact that this information must have been available or could have been made available at the lower stage itself. And then there is no choice but for the superior appellate authorities to remand the matter back and relegate the matter back to the files of the TPO or DRP in transfer pricing or international tax matters cases concerned. So please share and share what is relevant. The challenge which we have found is when you share so much that most of the relevant information is lost. So either there's a hesitancy of not sharing, or when it is shared, we share in abundance. So miss the woods for the trees. Any other question we have, Divya?
Yes, sir. They are, but they are journal ones. The
We
another
can
is
take maybe one more because it's 41 by the watch you have.
yes, sir. The focus of government is to simplify the Income Tax Act. What, according to you, should be the focus of new income tax bill government will introduce in coming days?
Well, I think it should be user friendly. I mean, it's like buying a sophisticated electronic equipment with a user manual which is easy to read. And it's if the provisions of the act are user friendly and are aligned with global best practices, which are Indian customized. Remember, not everything which is followed in Western world can be blindly aimed and copied in Indian situation. If it is, if the global practices are transformed in let's say make in India kind of situation or made for India. So if keeping that in mind, just because the world is doing something else, we should also run after it, which the present government did very I think it was a great thought in terms of not pushing the button in terms of legislating the pillar one, pillar two tax proposals in the scheme of the statute. They waited. They wanted to see how the world is reacting. They never jumped the gun. It was a very wise and conscious thought. So if the act takes care of personal taxation, which more or less sounds attractive, the act takes care of SMEs, focusing on SMEs, a part of the act, and the part of the act takes care of its interaction with the international laws. And then you have penalties, prosecution provisions. So each aspect of the act, if it can concentrate, SMEs require a real facilitative mechanism in terms of understanding of act. If SMEs can be taken care of, I think it'll be a great achievement, so to speak.
Thank you so much, sir. Thank you so much for covering everything in detail. Uh, we are sure that everyone has learned so much, a lot from this session. Thank you so much.
Thanks. Bye.